Welcome to our IPO series. Today we will explore the IPO details of Standard Glass Lining Technology. Standard Glass Lining Technology is a leading manufacturer of specialized engineering equipment primarily serving the Indian pharma and chemical industries. The IPO is valued at 410 crores consisting of a 210 crores fresh issue and a 200 crores offer for sale. The company plans to use the IPO proceeds for funding capital expenditure, repayment or prepayment of borrowings, investments in its subsidiary, funding inorganic growth through investments or acquisitions, and general corporate purposes. Now let's take a quick look at the glass-lined equipment industry. Glass-lined equipment combines engineering precision with advanced glass lining technology, offering unmatched corrosion resistance and durability. These equipments are widely used for essential processes such as chemical synthesis, fermentation, and controlled reactions, ensuring both efficiency and safety. Glass-lined equipment plays a pivotal role, particularly in the pharma and chemical industries, where precision and reliability are non-negotiable. The Indian glass-lined equipment market is set to grow at a robust CAGR of 10.1% from FY 2024 to 2029. The pharma and chemical sectors are dominating the industry, accounting for 75% of end-user demand. Market leader GMM Pfaudler holds a 33% market share, while Standard Glass Lining Technology ranks at third with a 16.7% market share. Key factors driving growth in the industry includes rapid expansion of the pharma and chemical industries, rising demand for reactors and agitators in critical processes, strict Indian regulations in the pharma and chemical sectors to prioritize safety, which driving the adoption of glass-lined equipment for compliances. Now let's take a quick look at the company's business. Standard Glass Lining Technology is ranked among the top 5 companies in India for specialized engineering equipment in the pharma and chemical sectors. It's also one of the top 3 manufacturers of glass-lined stainless steel and nickel alloy equipment, as well as PTFE-lined pipelines and fittings. In the Indian market for reactors and storage tanks, the company holds a 4% market share. The company holds a significant 10.4% market share in the Indian filters and dryers market. The company has a diverse product portfolio including reaction systems, storage, separation and drying systems, plant engineering services. In terms of revenue, 56% of the company's revenue comes from reaction systems, while 30% is generated from storage, separation and drying systems. The company's products are used in various industries including pharma, chemicals, food and beverages, biotechnology and fertilizers. In terms of revenue, the majority of income is coming from the pharma sector, while the chemical sector contributed 12.5%. The company operates 8 advanced manufacturing facilities strategically located in India's pharma hub, Hyderabad. The company also has an extensive sales network with offices across India to ensure comprehensive market coverage. Its manufacturing facilities are equipped with state-of-the-art technologies, including robotic welding for enhanced efficiency, 3D CAD systems for precise design, precision CNC manufacturing for high-quality production. Customer base including 30 of the 80 pharma and chemical companies listed in the NSE 500, with a total customer base of 347 companies. It has maintained a strong long-term relationship exceeding 3 years with 13 of its top 20 customers. It enjoys high customer retention with over 80% of its top 20 customers placing repeat orders. Let's dive into the company's growth strategy and how it plans to scale in the coming years. The company is actively expanding its product portfolio. Recently, it has commenced production of PTFE line pipes, started supplying vacuum pumps. In addition to its current markets, the company plans to enter new end-user industries such as oil and gas, paints and coatings, edible oils, flavors and fragrances, aerospace and heavy engineering. To support growth, the company plans to expand its manufacturing capacity. Over the past years, it has consistently spent more than 4.5% of its revenue on capital expenditure. The company is also focusing on growing its export presence. While exports contributed less than 1% of income over the last 3 years, they now accounted for 6% in the last half year. The company also plans to drive inorganic growth through strategic acquisitions and alliances to further expand its reach and capabilities. Let's take a look at the key risks the company faces in its operations. The company has operational risk as all 8 manufacturing facilities are located in Telangana. Any economic or political changes in this region could significantly impact the company's operation. More than 80% of the company's revenue comes from the pharma and chemical sectors. Any cyclical downturns or disruptions in these sectors could have a direct impact on the company's financials. Raw material expenses account for around 72% of the company's revenue. Any fluctuations in raw material prices could have a sustainable impact on its cost structure and profitability. The company faces intense competition from other industry players, including major competitors like GMM Fodler, HLC Glasscoat, Termax, Anup Engineering, and Proj Industries. Now let's take a look at the company's financial performance over the past years. Between 2022 and 2024, the company's revenue and PAT has been doubled, driven by strong growth. It has maintained a consistent EBITDA margin of 17 to 18% and a PAT margin of over 10%. The company also enjoys a high return on capital employed ratio, indicating strong returns from its invested capital. Additionally, the company's debt to equity ratio remains below 1, reflecting a comfortable debt structure. Let's take a look at the promoter group and their shareholding in the company. Before the IPO, the promoters and promoter group hold 72.49% of the shares. Nageswara Rao Kantula, the managing director of the company, hold 4.15% of the company's shares. Kantula Ramakrishna and Kantula Krishnaveni are executive directors, each holding more than 20% of the company's shares. After the IPO, the shareholding of the promoters and promoter group will decrease to 59.87%. Finally, let's discuss the price range and important timelines for this IPO. The IPO price range is 133 to 140 rupees with a minimum lot size of 107 shares. The minimum investment required is 14,231 rupees. At the upper price band of 140 rupees, the price to earning ratio stands at 43. As of January 5th, the company's IPO grey market premium stands at Rupee 97 per share. With the upper price band at Rupee 140, the shares are expected to be listed at Rupee 237, offering a potential premium of 69.29%. The grey market premium reflects strong investor demand and investors are willing to pay more for the public issue. The IPO opens on Jan 6th and closes on Jan 8th. Share allotment will be done on Jan 9th and the shares will be listed on Jan 13th. These are the key details of this IPO. Please conduct your own due diligence before applying for this IPO. Thank you for watching. If you like the content, please subscribe to our channel.